Dear ladies and gentlemen, it is my pleasure to be here today and to hear a lot of very inspiring speeches and meet people who seem quite committed to building a new sustainable future for our world and also having a more sustainable approach in finance. Now off to the hottest topic of the day, I would say. I would like to talk about investing in times of climate change. And I would like to start with a quote that, to my, in my mind, says it all. The combination of the weight of scientific evidence and the dynamics of the financial system suggests that in the fullness of time, climate change will threaten financial resilience and longer-term prosperity. While there is still time to act, the window of opportunity is finite and shrinking. Probably from your first impression, it sounds something like a Greenpeace would say, or WWF, or maybe UN. But in fact, this is actually a quote from Mark Carney, the governor of the Bank of England, who's also the head of the Financial Stability Board, and that was said as recent as September 2015. Now, his speech to the Lloyd's of London Insurance Ball has caused quite a reaction in financial media and also around the world, because it came from such a high official and sounded something like Greenpeace would say, or a lot of other NGOs who were talking about climate change for a while now. Now, I think one of the reasons for that was that for long, climate change has been dismissed as being too far away, not material, or uncertain, not possible to reasonably predict. So hence, something that a lot of people were not taking seriously. But the reality is, we've got Arctic drilling that is now off limits to most. In the process to find Arctic oil and to start drilling, Shell has lost 7 billion of shareholders' money. And they were doing it in spite of a number of criticism and from the shareholders as well as NGOs who were saying that it was too expensive, uneconomical, and too much risk, and definitely bad for our climate and the environment, for such a pristine environment. China is shutting down 1,000 coal mines just this year. Now, I'm not going to, of course, talk about China and how good they are globally. I would say there's still a lot of problems, especially when you talk about their offshore investments in coal. But they're definitely cleaning up the country, and they're cleaning up the act there, I think. And they're now the leader in wind and solar power capacity, energy production. We've got, in the meantime, US coal industry that is imploding, also very similar globally, but US is striking. Just in the US, we have 26 bankruptcy cases, and 2 out of 4 biggest coal companies are filing for Chapter 11. And analysts are talking about a fundamental shift in the fossil fuels industry, and not normal downshift in the commodities cycle. I mean, one of the 2 reasons for that is, first, you've got the policy shift, the regulatory change. So, for example, a Clean Air Act coming from the EPA and a number of other regulations that are restricting the use of fossil fuels in the energy production in US. At the same time, you've got technological advances, and also the lower price for renewable energy and a lower price for gas. You've got the cases like Arch Coal and Peabody Energy, who filed for bankruptcies. They caused, I think, a wave of shock in the fossil fuel industry, and definitely reminded investors about how quickly things can change and how quickly assets can become stranded. I think there's definitely a lot of liability, and there's definitely a lot of uncertainty out there. And for example, in the cases of US, I think taxpayers will have to bear a lot of cleanup costs, cleanup costs from some of the mining operations that the bankrupt companies will not be able to cover now anymore, and or pay pensions or their creditors. We've got also weather-related loss events that have tripled since 1980s. I'm not an insurer, but I'm sure the insurance sector would also confirm that situation is slightly different than before. Currently modeled losses could be undervalued by as much as 50% if this new trend in weather patterns is actually the new normal. And this is again a quote from Mark Carney when he was addressing the insurers of Lloyd's of London. You've got fossil fuels under fire. The whole industry, we've got Exxon probe that has been at the moment current in New York. The company has been investigated for a lack of information that has been, the investigation is seeking information on whether Exxon has been lying to public and its investors for more than 40 years about the impact that climate change has on their profits. Now, as a result of this, I think concern, and previously already before, climate change resolutions are being tabled by a number of shareholders. A number of big shareholders are supporting and voting for that. So climate change resolutions at the AGMs of the fossil fuel industry. So we've got BP, Shell, Statoil, they voted unanimously for this climate change resolutions just recently. Like 2 weeks ago, Exxon has supported, well, there was 38% voted for the climate resolution at Exxon. The company is still challenging it, although it's been probed, and the rest of the peers, I think, are supporting it. I think the company definitely still is catching up with the reality. We have some other companies definitely diversifying or being more proactive than others. I'm not trying to support any of them, but I'm just saying that the trend is that you definitely should be looking at more renewable energy and try to diversify. However, it's still baby steps. I think most of the operations are still, and the revenues coming from oil and fossil fuels. We've got, perhaps the most importantly, we've got quite significant regulatory policy shifts that have been happening, especially in the last year. We've got the Paris Climate Change Agreement that was groundbreaking. At least this is the most groundbreaking so far. We have more than 190 countries who committed to limit the rise of global average temperatures to well below 2 degrees, well below, actually, with the aim of 1.5 degrees, because 2 degrees it's too much already, above the pre-industrial levels. Now, this leads to a very important concept notion that has already been mentioned, discussed today. It's called the carbon budget. The carbon budget is basically the assessment of how much the world, how much emissions can the world afford still. And I would say the most conservative assumptions for that, they estimate that roughly this carbon budget amounts to about 1/5 to 1/3 of our proven reserves of the fossil fuels. There are some estimates that are saying it's much less than that. In fact, 200 gigatons of carbon that we're still allowed to emit before we break a quite significant, basically before we get to the situation when things start getting spiraling out of control. And we're using about 40 gigatons per year currently. So if we think about that, in the worst case scenario, it's definitely even more urgent. But if we go back to the carbon budget, with the most, I would say, conservative, 1/5 to 1/3 of reserves have to stay in the ground. So we can use, that means the rest, 4/5 or 2/3 has to stay in the ground, means that the rest of these reserves are literally unburnable: coal, oil, gas. Now, this has definitely a direct impact on the valuations of these companies. And unfortunately, the markets is just catching up with this realization. Now, I think all of this makes it quite clear that it's no longer acceptable to dismiss climate change risk as a lack of materiality to your risk-reward metrics or strategy of the distant horizon. These risks, if not taken seriously, will only increase as the science and regulation around climate change hardens, and it is already doing it very quickly. Now, maybe if we talk about the reactions of the financial industry to the recent regulatory shifts and also the Paris Agreement, we've seen an unprecedented amount of institutional investors, especially pension funds, attending Paris Climate Summit in December. Mark Carney warned the investors that they potentially face huge losses from climate change. And as a result of the urgent need to get more clarity and also transparency around climate change disclosure, the Financial Stability Board has set up a climate disclosure task force, which is very similar to the enhanced disclosure task force that was set up after, in the wake of the financial crisis, to actually look at the accountability and transparency and reporting of the financial industry at that time. So now we've got the Climate Disclosure Task Force. And they basically will look at the amount, like a standardized reporting standards for the industry, so the industry, the global, the corporates, and also for the financial industry, and something that could be used for investors and shareholders. I would probably think like, surely there's already a lot of regulations that are telling investors to do that, or corporations. It's true, in most G20 jurisdictions, you've got a legal obligation, in most cases, to the issuers to disclose any material risk. So if you're doing stock exchange listing or your annual statements, probably you have to talk about every single material risk. However, in some cases, climate change is still not accepted as a material risk, and it's very different from country to country. So there's no standardization, and it's not generally enforced. There's also no requirements hardly any requirements, I think, in any countries for the financial sector to disclose their carbon footprints of their portfolios. So the Climate Disclosure Task Force report will be out at the end of this year. And they will have the voluntary, consistent climate-related financial risk disclosure standards or guidance to the investors and creditors. So I would say another thing, whilst waiting for the FSB report, the Climate Disclosure Task Force report, some investors in some countries are already taking measures and being very proactive, and I think it's good for them. France is clearly a pilot test for the development of the hard law around the climate change reporting. The Article 173 of the French energy transition law was passed by the Parliament, approved by the Parliament in 2015. And it's quite groundbreaking, I think. It requires now investors, which includes asset owners and investment managers, so asset owners as well, to disclose how they factor ESG criteria to carbon-related aspects into their investment policies. Now, every client has to have environmental objectives in their mandate as well, which should include disclosure and consideration of the their exposure to the climate risks, and also their contribution to the global fight to slow down the global warming, and also to the energy transition plans of France. I think the reporting is starting already this year, so this is pretty significant. Companies, investors can comply or explain why they're not complying at the moment, but they definitely cannot ignore this. I think, you would probably ask, what is the implications for foreign asset managers providing services to the French clients? It's also very similar. So foreign asset managers now must offer mandates, including the service of carbon disclosure. So if you have a French client who's managed out of Switzerland, you probably will have these concerns or these questions coming from your clients very soon, or you're already probably facing this. NATO would like very quickly to touch on the investor divesting and engaging. And so if we're talking the world of the big money, I think this climate change has been already considered as a big risk, financial risk to many. So we have a number of big funds, pension funds, divesting or directly engaging with corporations in a very active way. And I would like to talk about a couple of them. For example, Comgest, they see it as their prudential duty, together with CalPERS, to engage with the corporations and also to bring change within the company. Comgest does, for example, evaluation of their carbon. They do carbon optimization and carbon footprint testing of their portfolios on a regular basis, and they don't invest in fossil fuels industry at all because they see its lack of visibility to the future earnings at the moment because of regulatory shifts and lack of disclosure. Norway's sovereign wealth fund, we actually worked quite a lot. Greenpeace worked a lot with them together with the Ministry of Finance during the process of finding the best way and strategy to divest. But their oil fund is basically one of the most proactive fossil fuel divestors. Their divestment plan size is 67 billion Norwegian kronas. They are still in the process of doing that. So far, they've divested from 52 companies. A lot of them are coal companies, some of them major deforestation companies. And mainly it's because they see that the social environmental violations, they don't link with the profitability, and they see it as complete, common sense just to divest or engage. But divest, very strictly because they have very strict rules. We also have California recently passing a bill requiring CalPERS and CalSTRS, so the pension funds there, to divest from coal. So they will be also divesting very soon. Maybe some of you have seen a recent Moody's report, and I'm sure also the other credit agencies have issued something similar, but the Moody's has looked at the rated debt in the global markets and analyzed 86 sectors, and basically they highlighted that there is 2 trillion of rated debt, which has immediate or emerging elevated exposure to environmental risks. Environmental risks include obviously the direct environmental hazards and also policy changes that will be set up in order to reduce the hazards. They also see that further 7 trillion of rated debt is also at risk of it's a similar risk or credit profiles that are at risk of downgrades over a longer period of 5 years or more. Now we've got, if these are the issues that are quite dear to your heart, or you as an investor or family office, external asset manager, or your own portfolio, if you think that this makes sense and this is something that you're concerned about as well, I think it's granted that you should start dialogue with your bank or your research provider, just to understand whether they're also on the same level of thinking, because things are changing very quickly. And a couple of questions you could ask your bank would be, first of all, how would you respond to the French law? And if you're actually considering this already, then maybe I could also benefit from similar services as my clients in France, as your clients in France. Can you do a low carbon optimization for my portfolio? Do your research that you provide, and also structured products, for example, that you provide, do they take climate change scenarios and impacts into consideration? How do you manage the bank's proprietary climate change risk exposure? And this goes probably down to the counterparty risk. Just to give an example, I would say Swiss, 2 big banks, Credit Suisse and UBS, they are still number 12 and 13 in the world for financing to coal industry. And this is a lot of, I think, personally, Greenpeace also thinks like this, that it's too much exposure for Switzerland in terms of coal, just held by these 2 big banks. Do you have a strategy to adjust your business model to a low carbon economy? It's another question that is actually applicable to every single corporation in this world. I think that one of the reasons what I'm leading to is I live in Switzerland. I work in this financial industry in Switzerland as well as London before, but Switzerland is quite dear to me, and I've always been admiring the level of service that has been offered here in terms of client advice and the reliability and trust that the clients have for us, for the financial industry. Now it's also important for us to remember that we're world's #1 in cross-border asset management. So we are the biggest center for cross-border asset management in the world. And I think for Switzerland, it's perhaps the most important issue, more than, say, for France, more than probably other countries, because we do manage these assets of a lot of other clients, and we don't obviously want this money to move away. That's why I think climate change-informed advice should be seen as, obviously, as a first fiduciary duty, but at the same time as an opportunity of competitive differentiation, and also potential for this opportunity to be gone and having a lot of assets outflows. When clients, if we're too late and if we're behind the curve and we're not as competitive and it's not forward-looking as our peers in Europe or abroad. That's why I really would encourage the whole financial industry in Switzerland to offer a low-carbon portfolio optimization, investment analysis, factoring climate change impacts to all clients. And this is just the basic stuff. And I'm sure there's a lot of green finance products, a lot of green finance investments are given. This is definitely an amazing thing where we need to go, but we need to also look at what we're doing with the rest of our portfolio. And I think Switzerland needs to step up its game. So to conclude, I would like to just repeat that climate change awareness and mitigation is imperative, but it's also just simply pure common sense. Being ahead of the curve is a competitive advantage, but it's also perhaps for some would be about a question of survival. I think this is a new age of investing and a new growth story of the future. Thank you.